Section C, Performance Management, CMA Part 1. Question number 1. A major disadvantage of static budget. Just a very quick overview. What is a static budget? Let's say we made a budget for 10,000 units. That's what we planned, that this is what we will produce and sell. But the actual result could be more than this, or it could be less than this. This might be our actual production and sales. This might be our actual production and sales. So this original static budget becomes totally irrelevant because you can't compare 10 versus 12 or 10 versus 93. So for this, what we do, we draw up a new budget called the flexible budget. If the actual output has been 12, we revise the budget for 12, thereby comparing a budget for 12,000 with the actual performance of 12,000 units. Or if the actual output has been 9,300 units, we would revise our budget to 9,300 units. So now we have a 9,300 units budget numbers for cost and revenue to be compared with the actual result of 9,300 units produced and sold. This is the beauty of the flexible budgeting, that it's adjustable. Now, this is the background. Let's see what is the right option. A major disadvantage, mind the word, a major disadvantage of a static budget is that it is more difficult to develop than the flexible budget. This is absolutely wrong. Static budgets are simpler to prepare. Just you need one level of activity, tuck, budget is ready. This is a wrong statement. C. Variances tend to be smaller than when the flexible budgeting is used. This is again incorrect because budget variances could be more or less. This is not the criteria. In fact, variances are often larger when you compare the original static budget with the actual result. So this is again not the right statement. Variances are more difficult to compute than when flexible budgeting is used. Again incorrect, because they are easier to compute, but they are less meaningful. Because if you insist that I'm going to compare 10 versus 12, go ahead, do that. Or 10 versus 9,300, yes, go ahead, do that. You can do that. It's easy to compute, but they are not meaningful because you are comparing two unlike things. So it means A, C and D are incorrect options. Then what is the major disadvantage, and which is a correct statement? It is made for only one level of activity. Yes, a single level of activity, just like I told you, 10,000 units produced and sold. This is the major disadvantage of the static budget. Next question says, Arkan company's controller has prepared a flexible budget for the year just ended, adjusting the original static budget for an unexpected large increase in the volume of sales. So just to put it in some numerical form to help you understand, the static budget was originally prepared for 10,000 units produced and sold, but the actual result was stunningly high. You produced 35,000 units and sold 35,000 units. This comparison is meaningless. If you do, it's meaningless. Now, what's the next story? So if you compare these two, which is not a meaningful comparison, but if you insist that if we do the comparison, what would be the consequence? Arkan's costs are mostly variable. The controller is pleased to note that both actual revenues and actual cost approximated amounts shown on the flexible budget. If actual revenues, so they did make a flexible budget, and they were pleased to note that the comparison between a budget of 35,000 units versus the actual performance of 35,000 units. So the revenue and cost were approximated. So this is exactly what you should be doing. But if you insist, if actual revenues and actual costs are compared with the original static budget, what would you observe? Let's say if you make this comparison, if you insist to compare these two, what would you notice? You would have the revenue for 10,000 units and cost for 10,000 units. When you compare these two with the revenue of 10,000 units, 35,000 units and the cost of 35,000 units, the difference you would see, this was the expected revenue at static budget level, but your actual revenue is much more, which is good, which is favorable. So your revenue budgets are favorable because this was the original expected revenue, but we are getting much bigger, larger number for revenue. But when you compare your cost with cost, this is what the expected cost was, but this is the actual cost. So this would look adverse. So if you compare these, what I have jotted down which option do you think is the right one. A says both revenue variances and cost variances would be favorable. Wrong. Revenue variances would be favorable. 35,000 units will get you lots of revenue, but cost variances would be adverse. So it's B. Revenue variances would be favorable. You get more revenue than what you originally planned, which is good, but your cost variances would be unfavorable because cost for 35,000 units would be much bigger than cost for 10,000, and since most of it is variable, and that is the reason cost for 35,000 units would be much higher. That's the main cause. So we got our answers perfect. It is B. A project manager has been asked to provide an explanation regarding 2220 favorable material variance on playground equipment project. Okay. We are not yet sure whether it's the price variance being favorable or it's the usage variance that is favorable. After further analysis, the project manager was able to break down the material variance into an unfavorable price variance. Now we know for sure if this amount is split, some of it is representing unfavorable price variance, and next is the favorable usage, quantity or efficiency variance. In other words, if you split this 2220 into two components, one is the price variance, other is also called the usage variance or efficiency variance or quantity variance. Right? It is 3920 favorable, whereas price variance is 1700 adverse. That's the whole story. If you add these two, 3920 plus less 1700, because adverse is negative, you get this number. So what can we conclude? What is the best explanation from these given options? A. Decision by the purchasing department to use new supplier resulted in the purchase of a material of lower price. Absolutely wrong. If the price was lower, we should have a favorable price variance. Right? Lower purchase price would cause a favorable price variance, not unfavorable or adverse. A wrong statement. B. Excellent scheduling by the production department enabled the purchasing department to reduce shipping cost. Totally irrelevant. Shipping cost relates to output. It is unrelated to material price or material usage. This is a totally incorrect statement. What about option C? Purchasing department purchased higher quality material, resulting in less wastage of material. Since you bought material of higher quality, it would be expensive, and this reason is to justify that the price variance was adverse. Since the material was of higher quality, so we just used a little bit of it and it worked very well. So since high quality material is pricey, that's why price is adverse, and higher quality material tend to be used less in quantity, so that's why the usage or efficiency variance or the quantity variance of material is favorable. It's a perfect explanation, makes absolute sense. It is the right option. What about D? Human Resources Department failed to hire adequately trained workers, causing material to be wasted. Untrained workers wasting material is we know this would happen, but this would cause both unfavorable quantity variance as well as price variance, right? Because your purchasing department bought expensive, that makes fine sense, it's adverse, but this efficiency variance should have been adverse, but here we see it's favorable. So this is not in keeping with the information given in the question. So C is absolutely the correct option. A company prepared a master budget on a budgeted sales of 100 units. Let's do this in a more elaborate way. So you made an original static budget, call it SB, thinking that you are going to sell 100 units at 100 each. So your sales is going to be 100 times 100, that is 10,000. That's the original static budget. Your variable cost is 50. So 100 times 50, your variable cost is going to be 5,000. Your fixed cost is going to be 2,000. So as per your original static budget, your income should be $3,000. Right? It says the actual sales quantity was 70 units. When preparing a flexible budget, the operating income will be. Now how the budget is flexed, look at this. This is how we flex the budget. Flexible budget will be prepared for 70 units because that's what we actually produce. Each unit sells for 100, so that means the expected revenue is $7,000. Variable cost is 50. 70 times 50, that is 3,500. And fixed cost cannot be flexed. Remember, fixed cost cannot be flexed. It can only be split on number of months, so it stays the same. So if this is so, these are the negative numbers, of course. So that will give you a flexible budget operating income of 1,500. This is what you're going to use with your actual result of 70,000 units produced and sold. Since we don't have them, so that is what we cannot do. So yes, this is the flexible budget operating income. A is the correct option. Use of standard costing system can include all of the following advantages except it assists in performance evaluation. Yes, it's an advantage. It's absolutely right. Well, how? Because variances show efficiency levels, material usage, labor usage, material price, labor rate, variable overhead efficiency and all that. So this is true. It's an advantage. B, emphasizes qualitative characteristic. Well, standard costing focuses on quantitative data, numbers, not qualitative factors. So this is neither an advantage nor disadvantage. It's a wrong statement. It's an incorrect statement. Right? What about option C? Standard cost permits development of flexible budgeting. Absolutely right. Standard costing helps adjust cost to activity level. That's exactly what we did. This was the original static budget. Since the actual output was 70, so we would revise the whole static budget as per the 70 quantity which is actually produced. So yes, this is exactly possible because of standard costing. So this is an advantage. What about D? It allows employees to better understand what is expected of them. Absolutely right. It provides measurable performance targets, tells purchasing manager what is the price they should buy at, tells the production management what is the standard quantity of labor hours they should use, what is the standard quantity of machine hours they should use. So it allows employees to better understand what is expected of them. This is an advantage. This is the way, ladies and gentlemen, you do your theoretical questions so that you understand each and every word in every option. Which of the following statements is correct? Of the following statement is correct concerning a flexible budget cost formula. So there are certain options given. You need to see which of these statement is correct related to flexible budget cost formula. So read it up. Variable costs are stated on per unit basis and fixed costs are stated in total. If you remember that your cost function, total cost, is made up of two components. Fixed costs normally is given in total, let's say $10,000, and variable cost is given like $15 per unit. So this is how standard cost formula works. Your variable cost is given on per unit basis, absolutely right, and fixed cost is stated in total. This is how flexible budget cost formula works that you see to the right of your screen. Correct. Next, the monthly sales volume of Sugar Corporation varies from 7,000 units to 9,800 units over the course of a year. Management is currently studying anticipated selling expenses along with the related cash resources that will be needed. Which of the following types of budgets? 1. Should be used by Sugar in planning. 2. Will provide Sugar the best feedback in performance reports for comparing planned expenditures with the actual performances. So we want two things simultaneously. We want some budgeting methodology to be used in planning and other for performance evaluations. So planning versus performance reporting. We have two budgets, of course, static and flexible. So which of these combination is more suitable? Let us discuss. If you take static budget and flexible in planning, so it means you're planning for just one level of activity. We want more flexibility. Flexible budgets adjust for actual activity. So it is useful for both planning as well as performance evaluation. So we build various scenarios. Maybe we would like to plan for 10,000 versus 12,000 versus 18,000. So these are under planning. So planning can be done on various scenarios. And when the actual output is 12,000, we will again use a budget of 12,000 versus the actual results of 12,000. So it means flexible budgeting is good for planning also. We can create budgets at different levels of activity under different scenarios. And then of course for performance reporting, we always use flexible budgets. 12,000 budget versus 12 actual. So it means flexible budget are very helpful both for planning purpose under multiple scenarios and as well as for performance reporting, because you need to compare a budget of 12,000 with the actual performance of 12. This is the right comparison to make. The following performance report was prepared for Dale Manufacturing for the month of April. We have the actual results of 100,000 units. The budget was made for 80, and we made an extremely stupid mistake of comparing 100 versus 80 to generate variances. Let's say if they have done, but for practical purposes, it is of no use to me. This is a very inappropriate comparison. The right comparison should have been that we would draw a new variance called the flexible budget variance, flexible budget for 100,000 units budget. So this is the new budget where we compare our actual performance of 100,000 units with the flexible budget of 100,000. Anyways, this is not the agenda for now. So this is it. This is the original static budget. This is the actual result, and these variances have been calculated. They are called static budget variances. Very limited in application and utility. Useless, I would say. The question says, using flexible budget data, total sales volume variance. If you know your formula, I've shared the formula sheet in our group. Sales volume variance is calculated this way. Actual quantity versus original static budget quantity multiplied by the budgeted unit contribution margin. Actual quantity sold is 100,000. Good. As per the quantity of original budget, 80,000. Budgeted unit contribution margin focuses your attention on budgets. So this is the sales revenue for 80,000. This is the variable cost for 80,000. So if you calculate the difference, that is 160 less 96, it's $64,000. $64,000 is contribution, because sales minus variable cost is your contribution. This $64,000 contribution was to be earned for 80,000 units. So that will give you contribution per unit, and it is budgeted contribution per unit because we have used budgeted numbers. It is 64,000 over 80,000. So that gives you 0.8. So budgeted unit contribution margin is 0.8 calculated from the budget. So 0.8 multiplied by 20,000, and it's a plus number. I told you the formula sheets I've shared with you, they have been arranged in a way that any plus number would mean favorable and any negative result of any formula would mean an adverse or unfavorable variance. So since it's a plus, so it is 16,000 favorable. C is the answer. Next, of the following pairs of variances found on flexible budget reports, which pair is most likely to be related? Okay, let us first discuss A. A says material price variance. Material price variance is the standard price of material versus actual price of material multiplied by the actual quantity purchased. And variable overhead efficiency variance, it is standard quantity of hours, labor hours or machine hours we should have used versus actual quantity of hours we used multiplied by the variable overhead rate, which we call SPV. There is nothing related. Totally, these are material, these are labor hours or machine hours. They are totally unrelated. There is nothing relating them. This is the wrong option. What about B? Labor rate variance. Labor rate variance is equal to standard price of labor, actual price of labor multiplied by the actual quantity of labor hours worked. And labor overhead efficiency variance, I shouldn't have removed it. Variable overhead efficiency variance, it's equal to standard quantity of labor hours we should have used versus actual quantity of labor hours multiplied by the variable overhead rate. So here we have the labor price, standard and actual. Here we have labor quantity. So they are not related. This one is of course not related. But look at this. Material usage variance. Material usage variance is how much material you should have used, standard quantity of material versus actual quantity of material multiplied by the standard price of material. This is the material usage variance. Labor efficiency variance, the standard quantity of labor hours allowed versus actual quantity of labor hours you used multiplied by the standard price of labor hour. Now just look at this. If you use more quantity of material, of course you would require more labor hours. If you use less quantity of material, that means it would take less labor hours. So it means they are connected. Poor material quantity will result in more labor hours being required, and vice versa. It means they are connected, right? Poor material quality can cause excess usage and extra labor time. So it means they are both connected. One affects the other. So these are two related. Let us also discuss the last one. Why not D? Labor efficiency variance. Labor efficiency variance is how many labor hours we should have used versus how many labor hours we actually used, multiplied by the actual quantity of labor hours worked. Just a minute, this is not it. Standard price of labor. Make sure your formulas are on your fingertips. And overhead volume variance, which you call the production volume variance, it is the standard quantity of labor hours allowed multiplied by the fixed overhead rate versus the fixed overhead budget. Totally unrelated. Totally unrelated. This is the hours allowed for the output you have achieved. So they are not related directly. So C makes more connection than other combinations given. An advantage of using flexible budget compared to static budget is that flexible budget, we just saw a little while ago, they can be adjusted. That was the advantage. Let us see one option one by one. Shortfalls in planned productions are clearly presented. This is not right. That's not the main purpose. That is just the production control issue, not budget flexibility. We are interested in budget flexibility. Standard cost can easily be changed to adjust changing circumstances. No. This is not why we prepare flexible budget. No, this is not the right option. Standards are not changed frequently. Please note, standards are not changed frequently in budgeting. Flexibility refers to output levels, not standards. It's not that flexible budgets are used to revise standards. Rather, standards are used to make flexible budgets. This is not the right option. Standards are not frequently changed. They remain same for 2 or 3 years, right? And flexible budget is not the reason why we change the standards. It's the changing circumstances. Price of material may have gone up. Labor rate may have gone up. Our production system may have changed, right? So this is not the right option. Fixed cost variances are more clearly presented. Again, incorrect. Fixed cost remains same. Static budget and flexible budget, please note, it's a fine point. Static budget and flexible budget, they have the same fixed cost. If fixed cost is $10,000 in the static budget, it will be $10,000 in flexible budget, right? So flexible budget are primarily drawn up to adjust for variable costs. So this is wrong as well. So D is the right option clearly. Flexible budgets are the budgeted cost for a given output level can be compared with the actual cost for the same level of output. Excellent. Like we have drawn up a budget for 10,000 units and now we are going to compare it with the actual cost and revenue for 10,000 units. 10,000 budget versus 10,000 actual. This is the main reason why flexible budgets are more useful. Budgeted cost for a given level of output 10,000 can be compared with the actual cost for the same level of output. This is the reason why do we draw flexible budgets.